Today's topic could be ratio analysis. First, a definition of what ratio analysis is. Ratio analysis refers to the use of the mathematical relationship between figures of the financial statements to make informed judgments. We would look at the ratios that are calculated on the income statement and on the balance sheet. These are standard ratios that everyone uses. And if you are going to analyze an income statement or a balance sheet, these are the ratios that you would need to use. And for there are many more ratios than what we would use in this presentation. The ones that we would use are those that are required by CXC for your CSEC examination. First, we have ratios that are calculated on the income statement, the trading account section. The top half of the income statement is called the trading account, and there are three ratios there that we need to calculate and interpret. The first one is what is called the gross profit percentage. We see it in this section over here. And it is the gross profit in relation to revenue or sales. Sometimes this ratio is expressed as gross profit in relation to turnover. Turnover is just another word for sales, right? And when we talk about sales there, we're talking about the net sales after we take off the returns. The next ratio that we want to look at is the markup. Gross profit in relation to cost of sales, right? So the first one was in relation to sales. This one is in relation to cost of sales. And we measure it again as a percentage. And thirdly, we have the rate of inventory turnover, also called stock turnover. Sometimes it is called stock turn as well. This is the cost of sales divided by the average inventory or the average stock. Okay, this one is not a percentage, but a number of times. Okay, how we calculate these ratio? The gross profit percentage or GP is calculated by taking the gross profit from the income statement, divided by the sales or revenue, and multiplying the result by 100 to bring it to a percentage. Okay, that will give us the GPP as a percentage. The markup is gross profit, not on revenue this time, but on sales. So the gross profit from here is the same as the gross profit from there. Okay, and we multiply by 100 again to make it into a percentage. All right, the rate of inventory turnover is equal to the cost of sales, the same figure as we have here, divided by the average inventory. To get the average inventory or the average stock, you will need to take the opening stock, add it to the closing stock, and divide it by 2. Okay, so opening stock at closing stock is just 2 items. So that's why we divide by 2 to get the average. And This here is an error, right? You do not multiply it by 100. Okay, but it's equal to a number of times. Okay, we want to look at a work example now. This is a income statement. The top half only the trading account, and notice it finishes at the gross profit here. All right, anything under the gross profit would be the profit and loss section. Right, so to calculate the gross profit percentage, we have the formula again, gross profit divided by revenue or sales. And the gross profit in this case is 60,000. So we have 60,000 here. And the sales 240 here. And we multiply by 100 and we get 25%. What this would mean, how to interpret this, would mean that 25% of our sales is going to be profit, but that profit is before our profit and loss expenses is catered for. Okay, so gross profit. So 25% of our sales is profit before other expenses. Right? We can also look at it another way, that for every $100 of sales that we make, $25 would be profit before we pay our additional expenses. Now, next we have markup. Again, this is gross profit over cost of sales, and gross profit will be the same as here, 60,000, and the cost of sales this time is 180,000. So it's over 180,000, and we multiply by 100, we will get 33 and a third percent. Okay, what this would mean is that we are marking up the cost of our goods by 33 and a third percent to get our selling prices for the sale of our goods. Okay, that's what markup means. So notice it's on costs. Okay, so we can look at it another way too. For every $100 of purchases that we make, $33.33 will be gross profit, right? I'll say over that, I think I said it wrong. For every $100 of purchases that we make, that's the cost of sales, we will be making $33.33 in sales, in profit, sorry. The rate of inventory turnover is the cost of sales, same figure from here, and we divided by the average inventory, right? Now we have to work out this 15,000 here first, and we get a number of times. Notice we didn't multiply it by 100, right? So this here, as I said, is this one here is an error, right? Typo. Right, so on this side here, over here, we'll look at how we calculating the rate of turnover. To use the rate of inventory turnover ratio, you first need to work out an average figure for the inventory. Step 1, you add together the figures of the opening inventory. In this case, the opening inventory is 16,000 here. Look at the income statement. And and closing inventory is 14,000. All right, look at the income statement again. You see it here, and we add them together, we get 30,000. And because you only have two items, it was three items, you divide by three. With four items, you divide by four. But we have two items only. Step two is to divide that by two, right? So we get 30 over two, and you'll get 15,000 as the average inventory. So we divide the 180 over here. Look at the calculations on the right again. 180 divided by 15 equals 12. And it's a number of times, right? Anytime you divide in one item by itself, that here is dollars divided by dollars, you get a number of times, right? And we don't multiply it by 100. But this, if we get it multiplied by 100, it will give us a percentage, and that percentage wouldn't be so meaningful as 12 times. What 12 times it means? It means you are selling your average inventory 12 times. Okay? The more or the greater this figure is, the more profit you will make. So you try to sell your inventory as many times as possible, you make more gross profit. Okay? So those are the three ratios that you need to learn to calculate on the trading account. Just these three here, you have to memorize it. Remember, I told you in Form 4 there are some things that you have to memorize, right? You wouldn't be able to work out these things if you don't know that in an exam. They are not given to you, right? So you have to memorize these here. All right, be careful, particularly with this one here. You remember you have to work the average inventory first. Right, on the other section of the income statement, the profit and loss account, we have ratios there too. One is called the net profit percentage, and the other is the expenses as the percentage of revenue. We can use the total expense here and get expense to revenue, total expense to revenue, or we can pick any individual expense and compare it with our revenue. Right, so this one would be profit over revenue or sales, multiply by 100, and we'll get a percentage. Expense over revenue, multiply by 100. Okay, and this would be either be total expense, or it could be any individual expense like depreciation or rent or something, or it could be total of all of your expenses. Key terms in that is the net profit percentage is in relation to revenue measured as a percentage, and any expense as a percentage of revenue. Okay, any expense in relation to revenue measured as a percentage. Right, do you want to look at a work example calculating profit and loss account ratios? A business total revenue for the year ended 31st December 2018 was 400,000. This figure would be 400,000 as the sales. Its income statement included the following information. So this skips the it gives us the sales, skips the trading account, and go to the profit and loss account here, right? Because we are interested in profit and loss account ratios. So our gross profit is 140. It starts off where the trading account ended. And then we have general expenses, and wages. And these two together make up 106,000, and we have a net profit by taking the 106 from the 140, we get 34,000. The first ratio, net profit percentage, net profit over revenue by 100, will be 34,000 from here, divided by the 400,000 from the trading account. We multiply it by 100 here, we'll get 8.5%. Okay, what this means is our net profit is working out to be 8.5% of our sales. We can look at it another way as well, $8.50 on every $100 of sales or revenue that we make. Okay, the general expenses. All right, we can choose this one here, 2,400 over 400,000, and we multiply 100, we get 6%. Okay, so what this is telling us, that is if for every $100 of sales, 6% or $6 is profit. Sorry, $6 is spent in general expenses. And then we have wages. We can pick an individual account like wages, 82,000, and 82,000. Excuse me for that there. Let's click a wrong button. 82,000 over 400,000 by 100 equal 20.5%. All right, that is a bit high for the percentage of your sales, right? If we consider that the net profit is only 8.5%, right? Okay, so what this would mean is $20.50. We pay our workers $20.50 out of every $100 of revenue that we make. Okay, so that's the thing. And finally, we get to the balance sheet, where we have ratios there too. A statement of financial position is also called. And we have 5 ratios here that we need to know. The first one is the working capital or the current ratio. And this is a genuine ratio in that it's expressed as current asset colon the current liabilities. Okay, and in this, one peculiarity of these ratios is that the current liability is always expressed as 1. Okay, next we have what is called liquid capital ratio. It's a more strict measure than the current asset, the current liabilities, or the current ratio. It's also called the asset test because of the strictness of the ratio. In this one, we only use the liquid assets from the current assets. That means we leave out the inventory. And again, the current liabilities would be 1, and we add up the liquid assets together. Next, we have return on capital investment or return on capital employed, which is the profit from the profit and loss account divided by the capital employed or capital invested. We multiply it by 100 to get a percentage. Okay. Next, we have the receivables, collection period, that is equal to the accounts receivables or debtors divided by the credit sales. Notice it's not the total sales, but only the credit, because that's where you get your accounts receivable from. And we multiply it by 365. This figure you should know. It's the number of days you have in a year. And this would tell us how many days our debtors are taking to pay us our money. Right? The payables payment period is the opposite of the receivables collection period, and it's accounts payable over the credit purchases. Right? And we multiply by 365, and it will tell us how long our creditors are taking to pay our creditors. That has implications on whether we get discounts and trade discounts and so on from our suppliers. An illustration, we have here a balance sheet, and we will see how we calculate in the ratios on it and what they mean. Okay, again, some of the key terms are here. You will read them when I put it up in the classroom. Right, here we have all the ratios already calculated. I will go through them with you one by one. Right, this is how you would answer them in an exam. You would state the formula, even though they may not ask you for it, and select the appropriate figures on the balance sheet, calculate the final answer, and then you will give an explanation like this here. Right? You should work to 2 decimal places because you are working in dollars and cents, and 2 decimal places will tell you how much cents it is when you are. All right, so the current ratio is current assets to current liabilities, right? Like we said, you could state the ratio first, and then you do the workings in the next column, and you put the results here, right? It's 50,000 to 30,000. Now, like we said, the liabilities is always 1. Okay, and how we get the 1.67? We take the 50,000 and we divide it by the 30,000. And we get the 1.67. Okay, what this ratio means that our current assets is covering our current liabilities 1.6 times. Okay. Then you have the asset test ratio, which is a stricter ratio. We say the liquid assets, that is the current assets minus the stock, right? We can look at the balance sheet and see that, right? The total current assets is 50,000, and the stock or the inventory is 15, right? 50 minus 15 is 35, and that's how we get the 35 here. The current liabilities is the same amount as up here. All right, incidentally, that is taken from here. Current liabilities, the total. Okay, and we said the current liabilities is always given as 1. And to get the 1.17, we divide the 35 by 30. We get 1.17. Okay, what this means is that we can pay our liabilities, our current liabilities, that is, using our other assets other than the stock 1.17 times, right? Return on investment, we have net profit, over capital employed by 100,000. If we use the opening capital as the capital employed, or we could use the closing capital, or we could take an average of the two. All right, I'll just flip back over here to you. The net profit is here. The opening capital is the 225 here. The closing capital is the 245 here. Okay, so that's how we get these figures in here. That's why we got it 60,000 to 25. We could use that, but you should state which one you're using, or use whatever if they don't give you all three, like they didn't give you the average capital, so you shouldn't use that in an exam, right? If they give you both of these, choose one of these, right? Or you could calculate here, right? And you put them over, multiply by 100. What this means is that for every $100 of capital that you invest in the business, you get $26 in profit. Okay, now we're looking at the receivables. We take the accounts receivable divided by the credit sales, where we got these figures from. Okay, we're told up here that our credit sales was 372, and our credit purchases is 300,000, right? For those figures, the in accounts receivable figure is 30,000 here, and the accounts payable is 26 here. Okay, so that's where they are coming from. And we have 30 over 372 by 365, and that equals 30 days. So 30 days is a normal amount of credit that you give your customers, and if they are paying within the 30 days, you have no problem, right? The accounts payable is 26 over 300 multiplied by 365, and we get 32 days. So we have a problem here, right? It means you are not paying your suppliers on time. They could ditch you, and you don't sell to you again, right? Because you're breaking the credit period of 30 days. Okay. It also means that you are not taking advantage of cash discounts for prompt payment and things like that. Okay, so that is the work example. We will do another one again, right? So this would bring us to the end of this presentation.